It may be a long way from Wall Street, but this small financial firm has been central to developing a cutting-edge investment strategy known as managed futures.
If you don't know anything about the business, we trade commodity futures contracts. We buy, price goes up, we make money, we sell it.
Dunn helped create this market 30 years ago and remains one of the more successful futures funds in the business. In 2008, when global equity and bond markets declined steeply, Dunn came out ahead, way ahead. The firm retains 25% of profits generated by its trading strategy. But if the $1 billion or so it has under management this year makes no gains, Dunn takes no fees.
We don't want any conflicts of interest. So if the investor wins, we win.
The success of Dunn and other managed futures pioneers has helped create a $330 billion global market. But Dunn's profit-sharing only fee structure is extremely rare in that market, and consequently, so are win-wins for investors.
Bloomberg Markets magazine sifted through thousands of SEC filings to track the performance of 63 managed futures partnerships between 2003 and 2012. Over that decade, the partnership saw gains of $11.5 billion. But the fees, commissions and expenses wiped out 89% of those profits.
That's not right.
You wouldn't say that the fee levels applied on some of these funds are acceptable?
In no way is 89% of the profits acceptable. The problem is that I don't think people know this. I don't think investors, consumers understand this. I think regulators need to require that they communicate it right up front. It needs to be very clear to investors what the fees are.
It's very difficult for me to take a day or two and find all the fees in a fund. The idea and expectation that folks who aren't professionals can find these fees and assess their impact on their performance is really absurd.
Have you thought about managed futures yet?
Van Slyke says the managed futures industry, which can now market itself through television ads, is unhelpful for retail investors, but very valuable for fund marketers and managers.
Wealth is not being created nor destroyed in the futures market, but there is trading going on. So the only people really generating profit in that arrangement are the middlemen.
Among the middlemen to have profited from managed futures funds are Morgan Stanley, Citibank, and California-based Altegris.
The demand for managed futures has been so strong that...
Since 1999, Altegris has encouraged customers to invest in London-based Winton Capital Management through its Altegris Winton Futures Fund. Winton only permits large institutions to invest directly in its funds, but thanks to its partnership with Altegris, retail investors can also see a piece of the action, at a cost. Between 2009 and 2012, institutional money invested directly into Winton's managed futures grew 11.9%. But some individuals who placed as little as $10,000 into that exact same Winton fund, but through Altegris, saw a loss of 10.1%, thanks to layer upon layer of fees.
The more intermediation there is, obviously, the more fees that are levied. Our primary concern is our relationship with the people that we interact with directly, but that totally does not mean that we're ignorant of the end consumer. We do feel as though we need the end consumer to be getting a good deal.
But with fees as high as 9% even in losing years, the good deals in this industry have been reserved for the managers and the brokers, rather than the investors.
Willem Marx for Bloomberg in New York.